How can you find hidden tax deductions for long-term care? Imagine uncovering ways to save money on your long-term care expenses that you never knew existed. That's what finding hidden tax deductions can do for your financial plan. When it comes to funding long-term care costs, understanding what qualifies as deductible expenses is key. If someone is considered chronically ill, meaning they cannot perform at least 2 activities of daily living like eating or bathing without help, or they need supervision because of severe cognitive issues like Alzheimer's disease, their care costs might be deductible. A licensed healthcare provider must certify this condition, often through a formal care plan that details the necessary services. The costs that qualify as deductions go beyond just personal care. If you are in an assisted living facility or a skilled nursing home, the medical portion of your bill, including maintenance and personal care services, can be deductible. If your stay is mainly for medical reasons, even room and board costs might qualify, but you need documentation showing the stay is medically necessary and follows a prescribed care plan. Long-term care insurance premiums are also a big part of the picture. If you buy a policy, the premiums you pay can be deducted within IRS limits based on your age. For example, in 2024, individuals over 70 years old can deduct up to $5,880 of qualified premiums if they itemize. These premiums can often be paid from a health savings account, which adds a tax advantage. Benefits paid from these policies are usually not taxed, making them a smart way to cover costs. To really maximize your deductions, you need to look at your total medical expenses. The IRS requires that your total medical costs, including long-term care, exceed a certain percentage of your adjusted gross income, either 7.5% or 10% depending on the year and your age. Only the amount over that threshold is deductible, so gathering all your qualifying expenses is essential. Timing also matters. If you sell a highly appreciated asset like a home in the same year you have large long-term care costs, your medical deductions might offset some capital gains taxes. Planning these transactions carefully can boost your savings. From an elder law perspective, keeping detailed records is vital. This includes medical certifications, care plans, and receipts for every expense. Working with an elder law attorney or a tax professional familiar with long-term care can help you identify all possible deductions. They can also advise you on how to structure your care funding to get the best tax benefits while protecting your assets. In summary, to find hidden tax deductions for long-term care, first confirm the person qualifies as chronically ill with proper certification. Include all qualifying personal care and medical expenses, and consider deducting long-term care insurance premiums within IRS limits. Add up all your medical costs to see if they surpass the IRS threshold, and plan your expenses and asset transactions carefully to maximize savings. These steps can help ease the financial burden of long-term care while making sure you're taking full advantage of available tax benefits.